Bank of America recently reported staggering unrealized losses of $131.6 billion, making it one of the worst-performing bank stocks this year. This has led to a decline of around 17% in Bank of America shares. A similar situation can be seen with JP Morgan Chase, which is grappling with losses exceeding $40 billion. On a broader scale, the entire U.S. banking system is faced with approximately $1.8 trillion in losses. These alarming figures have dire implications for the future. It is highly likely that we will witness bank runs and a loss of trust in the system. As the public becomes increasingly skeptical about the stability of these financial institutions, people will start making different decisions pertaining to their finances. Now, let's delve into the specifics of Bank of America's predicament. The bank has recently warned consumers that they would experience significant hardships, a predicament that CEO Brian Moynihan acknowledges has now come to fruition. This announcement sent shockwaves throughout Wall Street as it became clear that consumers have finally reached their limit. This revelation from Bank of America aligns with their prediction back in March, when an analyst warned that the Federal Reserve would deliberately push consumers to the point of pain in order to control inflation. A similar situation occurred with Silicon Valley Bank, which also believed that their portfolio would not generate real losses. However, a run on the bank forced them to sell their securities and ultimately led to their downfall. Experts suggest that it is highly unlikely that Bank of America would sell their securities at a loss, because the bank has a strong liquidity position with consumer deposits and higher capital. Additionally, holding the securities until maturity provides flexibility to avoid mark-to-market losses. The current trend of people withdrawing money from banks, as highlighted by prominent hedge fund manager Ken Griffin, could further exacerbate the situation. Griffin estimates that consumers have around $1 trillion in excess savings, but they are spending hundreds of billions of dollars each month. This increase in spending is expected to continue, especially as student loan payments for 43.5 million borrowers kick in. Consequently, bank deposits will continue to dwindle, particularly during the holiday season, placing additional strain on the banking system. JP Morgan Chase has already reported losses of $40 billion, indicating that other banks, such as Bank of America, may face even greater losses. Goldman Sachs has marked down or impaired its office holdings by 50%, and Bank of America is inquiring about potential losses in Goldman's commercial real estate unit. This significant decrease in value is cause for concern, as losses across the banking system are starting to skyrocket. It is evident that these losses will not spare small regional banks either, as the entire banking system is facing imminent challenges. Even banking regulators are acknowledging the severity of the situation. Sam Woods, a prominent banking regulator, stated that the current period is the most intense since the 2008 financial crisis. Unrealized losses in the banking system are estimated to be around $1.7 trillion, further emphasizing the gravity of the situation. The current situation in the financial sector is a cause for concern. What may initially seem like a minor problem has the potential to develop into a massive crisis. One clear indication of this is the increase in foreclosures in the United States. On August 10th, foreclosure activity experienced a temporary dip, but by August 19th, it had started to rise again. This trend is not limited to the housing market alone. Experts have pointed out that foreclosures are now being mirrored in credit card delinquencies and are predicted to extend to auto loan defaults as well. This interconnectedness highlights an alarming trend that should not be ignored. Banks, lending institutions, and financial providers are likely to face significant losses in the near future. This raises a crucial question. If our entire financial system depends on lending money to consumers, what will happen when these consumers are on the brink of financial collapse? Recent statistics indicate that the majority of Americans cannot afford an unexpected expense of $400. This implies that we may witness a wave of defaults over the next 12 to 36 months, spelling trouble for banks. These circumstances have far-reaching implications for the entire economy, a reality that is yet to be fully grasped by many. We can expect private lenders to emerge in an attempt to fill the void left by traditional banks. While this may seem like a solution, it is essential to be cautious as predatory loan practices often accompany such situations. The economy is on the precipice of significant change, with the banking sector bracing for a substantial impact. The imminent release of numerous predatory loans is a concerning development. This situation can be likened to the ill-fated Titanic moments before it collided with an iceberg. The magnitude of potential consequences is overwhelming. While the financial crisis of 2008 to 2009 was mainly a result of the real estate sector's collapse, the predicament we currently face is much more complex. It encompasses geopolitical tensions like those between Russia and Ukraine, as well as conflicts between Israel and Hamas. Additionally, the oil industry's challenges and the ongoing shift towards clean energy further compound the situation. Each of these factors is more significant than what occurred in 2008. Adding to the complexity is the staggering national debt, standing at a daunting $17 trillion. Additionally, interest rates are expected to remain higher for an extended period. This impending wave of change will create both immense hardship and unique opportunities for forward-thinking entrepreneurs and investors. Banks have employed the strategy of holding less risky securities until maturity, thus providing them with downside protection. However, in an environment of rising interest rates, this approach offers limited upside potential. Bank of America's chief financial officer, in a conference call discussing third-quarter earnings, stated that the bank anticipated zero losses over time due to their strategy of holding securities to maturity. However, Bank of America reported $106 billion in paper losses in the second quarter alone. The bank's holdings in securities held to maturity decreased from $614 billion in the second quarter to $603 billion. Nevertheless, their significant holdings of low-yield assets have restricted the bank's ability to generate higher profits by allocating their cash in money markets or other assets with better returns. The bigger concern arises from the extent of potential losses that will be incurred on all types of loans, such as auto loans, home loans, personal loans, and especially commercial real estate. As these losses accumulate, banks' reserves will continue to dwindle while their investments, including bonds, perform poorly. This raises questions about their ability to cope with the interest payments on loans that are not being repaid. We may witness a wave of consolidations, as even big banks like Bank of America are grappling with these issues. Imagine the even greater difficulties faced by regional banks, which are typically the lenders for small businesses and everyday Americans. The impact on everyday Americans will be more severe than ever before. Consequently, I foresee regional banks collapsing, further consolidation among larger banks, and a complete restructuring of the financial landscape in America. To me, this transition has been in the making for some time, and we are now in the front row, awaiting the unfolding of this unprecedented upheaval. What are your thoughts on this entire situation? Do you believe Bank of America could face a bailout? Or will we witness significant bank consolidations? Or do you think the reported $131 billion loss is not a major concern for Bank of America? It's worth noting that consumers are facing financial difficulties, with even J.P. Morgan Chase reporting $40 billion in losses and the U.S. banking system suffering from $1.7 trillion in unrealized losses. Is this a problem that signifies a big transition, or do you hold a different perspective? Please share your comments below, and let's engage in a discussion on this critical issue. Thank you for joining me today, and I look forward to our continued conversation.